any questions or here? Any questions?
Professor, we have a question. We have class Monday.
Yes, we have a class Monday. This coming Monday we have a class, but this coming Wednesday we don't have a class.
Okay, perfect.
Yeah. Okay, you're welcome. All right. So we have 6 classes remaining, including this one, until this semester ends, and then you're going to have the final exam. So I posted all the problem sets for chapter 12, 13, and 14. So you have every problem set for the remaining chapters. And I also bring you your attention. I want to bring your attention to the project. So the project, so let me stop share this. And let me share the Blackboard site. Okay, let's see. Now I need to go to Blackboard. Yeah, assignment section. So go to the assignment section. So open Blackboard and go to the assignment section of Blackboard. Okay, in the assignment section of Blackboard, you see the project that will be due by December 9th. That's the last day of this class. And there is an instruction, the Word document, and you need the data. The data from Bloomberg terminal, Walmart and Target's earnings per share forecast. So I posted this project a long time ago at the beginning of the semester for you to be prepared, plan ahead. But these data, Walmart and Target earnings prediction data, that prediction keeps changing. So I waited until a reasonable time. So I think it's okay. Now we can use the current forecast data. So today I downloaded the forecast from analyst forecast and posted the data and completed this assignment. So it will take, you still have a lot of time until December 9th, but I'm emphasizing this project once more because this project, it will take a while for you to complete it. So you must, if you, I hope you already started, but if you didn't, I see many students are working on it using Bloomberg terminal. So the idea is I provided the Bloomberg market concept, the instruction at the beginning of the semester in the announcement section. So I see many students created the BMC account and gaining knowledge to complete the project. So I see your progress. The nice thing is Bloomberg market concept to provide the progress of each student to the instructor. But I still see some students have not started the Bloomberg market concept, the e-learning module. Those students will be in big trouble. They delay until the last minute. So if you are one of those students who have not started Bloomberg market concept, you must start now and you must start working on those projects. This is 10% of your grade. So it's not just one assignment. This project is 10% of your grade, and late assignment, I cannot accept late assignment for this project because the due date is the last day and grading deadline is fixed. So this you must plan ahead and do the project. So let me quickly show you. Just when you click those assignment files, you will open, you will be able to see this instruction. So this is a project. So as you can see, I'm asking you to complete 2 modules. Bloomberg Market Concept has 4 more modules. Actually, there are more than 4 modules, but to earn a certificate, you need to complete 4 modules. Students need to complete 4 modules. But in this introductory class, I'm not asking you to complete even 4 modules. I'm asking you, asking for 3310, Finance 3310 students to complete only 2 modules. That's the minimum requirement. So economic indicator module and equities module, stock module, those 2 modules. So that's what I wrote here. Take the economic indicator and equity modules of Bloomberg Market Concepts e-learning course. And then use your knowledge to answer these questions. So this project was designed to make sure that you take the e-learning course, BMC course, and then answer these questions to demonstrate that you understand and you learned something important from that BMC e-learning course. So after taking the BMC modules, you should be able to answer number 1, 2, 3, 4, 5, 6 questions easily. And to answer question number 7, so question number 7 is extremely, especially important because this knowledge is closely related to what you learned in using the textbook. So remember in chapter 3, you learned ratio analysis. And this theory in chapter 3 and Bloomberg Market Concept in the real world, you combine these 2 knowledges. Also on top of that, I'm asking you to use the internet and go to the Walmart and Target company's website, investor relations website. So that's what I wrote here. Use the investor relations website of each company. So use Google and type WMT, Walmart, investor relations. Then you can click you can find the web address of Walmart company's investor relations website, and that website is a very good source of the most recent financial statement, the 10K annual report. So download the 10K, and it must be a very long document, but I don't expect you to read everything. It's a good thing to take a look at a well-known company like Walmart's annual report. That I recommend you to take a look, but it's not a requirement. You just find the data for this project, net income, and number of shares outstanding, and use that data to do the homework. So I see a movement in the chat box, so let me take a look. So what was the website again? Yeah, Jackie, investor relations. So what I wrote here, so use the investor relations website of the company. So yeah, let me show you. So let me actually show you. I show you. So here. Yeah, here. Yeah, I will share this website. Share. Yeah. So just type WMT, the ticker symbol Walmart, investor relations, and then you can go to Walmart investor relations website that has annual reports and all very important information. So Walmart target those publicly traded companies are required to submit 10K reports, 10Q reports, financial statements. So that public companies usually have investor relations office. So they're, the companies employ steps to support investors obtaining information about their stock. So professional analysts frequently use that investor relations website. So if you haven't used that kind of website before, this project is a good opportunity for you to get exposed to that kind of information source. So yeah, let me stop share this and go back to the project document. So, and also you will need the PE ratio calculation. PE ratio has two types. Trailing PE ratio using prior earnings, the most recent historical earnings, as well as forward PE ratio based on the estimated future earnings. So historical 10K reports show historical earnings, so you can use that information to do this part. But to calculate for the P ratio, you need the forecasted earning. And also you need the stock price data. So I'm asking you to use the stock price as of December 4th. So use the closing stock price at 4 p.m. when the market is closed at 4 p.m. New York time. You find the stock price of Walmart and Target and complete this calculation. So that means I don't know the correct answer yet. You don't know the correct answer yet. We will know the correct answer on December 4th. So I want to use this project. So this is an experiential learning project. So using this Walmart and Target example, I'm trying to give you an experience of applying your knowledge to the real world, real stock market movements. So that's one of the goals, learning goals in this project. So let me emphasize once more, this is a finance class. In finance, we are not just learning theory. So finance is about what's happening in the real world. So it's extremely important for you to learn how to apply what you have learned to understand what's going on in the real world, real time. Of course, this is a college level introductory finance class, so we have a lot of limitations, but still limitations in following real time, a lot of complicated activities in the financial markets, but at least we need to include some of the real world examples. So to help you understand how to apply the theories you learned to the real world activities and phenomena. So that's why I'm giving you this kind of assignment. So any questions so far? Okay, so if you don't have any questions, let me show you one more file.
Professor, I have a question.
Okay.
So for question number 7 and question number 7, we can get the net income and the number of shares outstanding from the 10K report, and then the closing price and the historical earnings per share, the net E0, that would be from Bloomberg, right?
So E0 is from 10K report, right?
Okay.
Yeah, and E1 is from Bloomberg.
E1.
Yeah, because E1 is forecasted number.
Mm-hmm.
Forecasted earnings. So historical 10K report doesn't have E1, right?
Yes.
Yeah. So E0 is based on the company's history provided by the company's financial report, 10K report. But E1 is supposed to be forecast. So who forecasts earnings? Analysts. So analysts, there are a lot of analysts out there. So how can we find analysts estimate for earnings? That's where we need the Bloomberg terminal. So I was about to show you that. So hold on. So I will.
Got it. Thank you, Professor.
Yeah, you're welcome. So this is the data. So you see this photo. You guys are seeing this Bloomberg terminal photo I took this morning, right? So this is this you can see from this photo. You can see this is your Walmart stock, and EE function. EE function in the Bloomberg terminal means earnings and estimates function. And this, what's the source of this database? Mean consensus estimate. So there are many analysts analyzing Walmart stock, and let's see, analyst coverage. So it looks like 27 analysts, 9 analysts, and 2 analysts. So currently 38 analysts analyzed Walmart stock, and they gave this recommendations, buy, hold, and sell recommendations. So 27 analysts are recommending purchase, buy, and 9 analysts issue hold recommendation, and 2 analysts recommend investors selling stocks. So these analysts are called sell side analysts. So they work for brokerage firms, and that provide information about stocks for those investors who are interested in investing in the stock market, because brokerage firms get fees when there are many trading. So brokerage firms hire experts, analysts, and provide an analysis report. Definitely those services are not free. So those who are in their network and their customers receive analysts, sell-side analyst report. And Bloomberg Terminal, the company Bloomberg is an information provider. Of course, it's not free. Bloomberg, by the way, how much do you know how much it costs to get this Bloomberg terminal service? It's very expensive. We get, Brooklyn College get an academic rate. See, I see a movement in the chat box. Yeah, Bloomberg terminal over, you think 10,000, it's a lot more than 10,000, Julian. Yeah. Actually, we are paying Brooklyn College. I think we are paying $16,000 per quarter. So $64,000 for 3 terminals per year. Yeah. And it's an academic rate. So they, Bloomberg company provides 3 terminals for $64,000 per year. And because it's an academic rate, they give us 9 more terminals, so 12 terminals. Yeah, okay, yes. Yeah, that's understandable because we only have 12 access, terminal access, and we have finance courses, we have over 500 students, so it's hard for us to provide access. So that's why in intro classes, we just use Bloomberg market concept. So that's understandable. But those students later who are gonna, finance students who will take the security analysis class, finance 5330, will have an access to the Bloomberg terminal functions. So because of that, and also that is $64,000, that payment has nothing to do with your tuition. We just, it's a Dean's office has worked hard to fundraise. So it's based on the, like, think currently the Copeman, Mr. Copeman's donation is paying for it, but because of the budget situation, I don't know how long that kind of service will be provided in the future. So everything is up. And I recently heard that New York City has $14 billion of deficit because of COVID-19. We have less travelers, fewer travelers, restaurants closed, so that means less tax income. New York City and New York State went down sharply, so budget cuts are everywhere. That means budget is tight everywhere, and Bloomberg terminal subscription fee, this kind of things can easily get cut. So, but still we have access to Bloomberg terminal, at least Bloomberg market concept, but the Bloomberg market concept access you currently have because of the generous donation, that will expire for you. That class code will expire at the end of this semester, so you need to be in a hurry. And while you take the BMC course, take notes. And when the campus will be open, the Bloomberg terminal will be open as well. But again, let me emphasize once more, over 700 students are competing for 12 terminals. So it's a very it's a competitive, and that's the nature. And so most schools, many schools don't have Bloomberg terminal, but we are in New York City, and also very expensive private schools. Some of those schools have Bloomberg terminal, but schools like us having a Bloomberg terminal available for undergraduate finance students, that's a very exceptional situation. So we need to fully utilize that kind of rare but high quality resources while it's available. But anyway, so for this project, you fully utilize the Bloomberg market concept, online access. That's $149 for other people, general public, but you get free access to that $149 PMC service because of the $64,000 payment the Dean's office makes because of the Mr. Coppelman's donation. So you fully utilize that kind of service, and that every semester at least 200 students take this PMC. So that means every year over 400 students learn through Bloomberg market concepts in Brooklyn College alone. So this is a very, and also those who took this PMC course can feel that that e-learning course, PMC e-learning course, is a very high quality educational material. So I strongly recommend you learn and take notes while taking that PMC course, and to remember. So in the future, if you need to use the terminal, you use your notes from PMC and use your knowledge to get the job done. And also, if you can go one step more, can earn a certificate, and you may list it on your resume. And in the future, when you get an interview for internship and full-time job, and you may tell them you have some Bloomberg terminal experience and be ready to answer any questions. So Bloomberg terminal is a very frequently used tools by professionals, so they may be impressed if you have good knowledge of Bloomberg terminal and demonstrate the knowledge. All right, so going back to this Bloomberg terminal earnings and estimate function. So based on this, analysts when analysts analyze stocks like Walmart, and they recommend buy, hold, and issue buy, hold, or sell recommendation, they must do valuation. Without valuation, how do they make buy or hold or sell recommendation? So those 27 analysts who issue buy recommendation, what does that mean? They think, those 27 analysts think the Walmart stock is undervalued. So they predict, they estimate that the stock price will go up. So the current stock price, when I took this photo, the stock price $149.37, but the target price, average target price of this analyst is $159.47. That's why many analysts are estimating that the stock price will go up in the future. But there are different opinions. So some analysts, two of them, you can see that they think Walmart stock price will go down. So that's why here you see mean consensus. So we are not seeing all those analysts, but if you use other functions in the Bloomberg terminal, you can see which company's analysts, like Goldman Sachs analyst, what is their estimate, JP Morgan's estimate, all those details. So how to find those details? Again, that kind of details will be taught. You can learn in Finance 5330. So this is Finance 3310, Principles of Financial Management class. So after taking this class, finance students will take Finance 3330 investment class and learn more about investments. And after that, those who are interested will take Finance 5330 security analysis class, and there all those details students learn. But here, this is an introductory class, so I'm just explaining some basics. But still, this is a real world, using Bloomberg terminal is to general public or ordinary investors. This is already an advanced concept, but for finance majors who aim at working for Wall Street firms, this is an introductory material. All right, so this is, so what you're seeing is the average here. So consensus overview. So how do these analysts know, estimate the target price? So you can learn how to analysts to do the valuation using the equities module, PMC module. And there are two methods, relative valuation and absolute valuation. And PE ratio is a relative valuation method, PE multiple, as you briefly learned in chapter 3. So most importantly, so to complete your project, you need E1. So that's E1 is next period's forecasted earnings. And that estimate is coming from this 38 analyst average, and that number is here, earnings per share estimate. Oh, but you may wonder, oh, why do we have two numbers? GAAP-based earnings per share Walmart estimate is $6.45. So that's the consensus average estimate. But adjusted earnings per share is $5.58. So many analysts, because they're like GAAP-based earnings are closely following GAAP, generally accepted accounting principles. But as I emphasized before, accountants' way of doing evaluating earnings may not be fully consistent with a cash-based analyst approach. So for example, one-time expenses or some unusual expenses that doesn't have a huge impact on long-term stock price forecast. So and many analysts use adjusted earnings. So that's why analysts provide both estimates, adjusted earnings and as well as GAAP-based earnings. But what is the earnings E0 data you get from Walmart's 10K report? That's GAAP-based earnings. So if you want to use the GAAP-based earnings from 10K report to be consistent, use this GAAP-based earnings per share forecast. But if you want to use adjusted earnings per share, that's okay. But in the project, either one is fine, but you need to clearly explain what you used. Did you use adjusted number or GAAP-based number? So yeah, either way is fine, but explain it in the project question number 7. So this is again, try to help this project question is to have you exposed to the real world practice. So any questions so far? So I posted this Walmart number as well as the target of the earnings forecast for Target company as well on Blackboard. So if you don't have any questions, let's go back to chapter 12 slides. Okay. So in chapter 12, 13, and 14, again, these chapters are for finding the right discount rate for a risky investment for a valuation. So we need the discount rate to find the present value. So remember, the value of any risky asset is the present value of expected future cash flows. So to convert future cash flows to time zero money, present value, we need the discount rate. Why do we need present value? For trading, to buy and sell, we need to know what's the fair value. Fair value is by definition value now. So price is by definition the money now, present value. So any future cash flows present value, to find that we need the discount rate. And if I ask you, what is the most important lesson you learned so far in chapter 12 about the right discount rate for a risky investment? So use one word that determines the right discount rate for a risky investment. So what would be your answer? So let me repeat. What is the most important word you should use when I ask you to explain how to find the right discount rate for a risky investment. Use just one keyword, one English word to explain. Returns is what we are trying to find. So discount rate is the return. So the right discount, to find the right discount rate, you are getting closer, premium. So yeah, yes, the investors' expected return, required return on risky investment is the discount rate. But what determines the right discount rate? The return investors require. So as Julia mentioned, that's premium, risk premium. So the right word I expected was risk. So but Julia, you did a good job. So risk determines the risk premium. So in other words, suppose you're looking at a company like Walmart. So Walmart is a big company and they have many projects and they may need to build a new store that can be a new project, or physical store, building a physical store, or they may need to invest more to expand in the e-commerce area. So they may need to develop a new platform to compete with the Amazon in e-commerce. So that kind of project, or they may, Walmart may need to start, may wanna expand some their pharmacy area offerings. That can be another new project. So my question here is, does Walmart need to apply the same discount rate for the evaluation of those 3 new projects? No. Those three new projects will have different risk. So for higher risk, more risky projects, the discount rate should be higher, and less risky projects, the discount rate should be lower to find the NPV of those projects. So how to find the right discount rate for a risky investment? But the problem is, risky investments are not traded on the market. Investments projects are not traded on the market. So how do we know what's the risk premium applied to those risky investment projects? So that's why in chapter 12, how can we get data? So we know more risk means more risk premium, so discount rate should be higher. So the idea is, where can we go to find the data, the right risk premium, and how to measure risk, and how to evaluate, how to find the right discount rate? So this is the most important question we are trying to answer in chapter 12, 13, and 14. So when we finally finish chapter 14, you are gonna have answers to those questions. How to find the right discount rate for Walmart pharmacy project. So that kind of question in chapter 4, at the end of chapter 4, you will have a better answer. So preview, 2 methods, pure play approach and subjective approach. Those are 2 answers. What do I mean by that? I actually posted the problem set, a video that includes a video question, did include video questions in chapter 14, homework problem set. So down the road, you are gonna learn it. So you need to go step by step, chapter 12, 13, and 14. But the issue is, chapter 12, 13, and 14, these chapters have a lot of interesting in-depth discussions. But unfortunately, in Finance 3310, you don't have a lot of time to discuss all those interesting things. So my expectation for you will be reasonable. So I'll try to make the content manageable, but at the same time, I need to give those students, finance students, accounting students who will take the next level finance course, which is Finance 3330 and 3311. Those students give some introductions, because those students who will take the next level finance course, any next level finance course will need chapter 12, 13, and 14 concepts again in the next course finance courses, and learning building a more solid background in those 3 chapters will be very, very useful. So that's why I want to give those students some introduction as well. But again, whether you will be taking finance courses, other finance courses after this or not, these 3 courses. So I also want to give some explanations to those who will not take any other finance course in the future. Finance is not my major, so I'm majoring in management or marketing. So I'm not going to take another finance course in the future. If you are that kind of student, is still chapter 12, 13, and 14 are will be very useful and helpful for you, because these days, in your parents' generation, employers usually had provided pensions, defined benefit plans, and provided pensions. But these in your generation, that kind of employment is getting rare and rare. So most people, young generation, those people need to manage their investment, retirement fund, and fund after you have a full-time job. Your employer will provide retirement account, 401k account. So these days, everyone should be familiar with how to manage their personal finance, and then chapter 12, 13, and 14 knowledge will be extremely beneficial for you to understand how to manage your portfolio for the future. So, all right. So any questions, comments? So that's why in chapter 12, we are taking a closer look at the history of the capital market to learn about what kind of returns risky assets earned. So the most important lesson is there is a trade-off between risk and return. So historically, assets that have higher risk earned higher average return. I'm not talking about just 1 year. Long-term average return was higher for riskier investments. So that was the lesson we learned on Monday. And if I ask you, okay, then how do we measure risk? So to relate the risk premium to risk, we need to measure risk. So how to quantify risk? Then what should be your answer? How do we measure risk in finance? Your answer should be use volatility. So volatility of stock return is a measure of risk in finance. And what do we mean by volatility in finance? What should be your answer? It's the standard deviation of the asset's return. And What do we mean by standard deviation? How do we measure the standard deviation of Walmart stock? If I ask you that question, what should be your answer? Oh, you can calculate, you can use historical price and dividend data to calculate holding period return for each period. So for example, if I ask you to calculate the volatility of Walmart stock and compare it with the target volatility using 2019 stock market data, daily return data. And what would you do to answer the question? So usually there are 252 trading days in a year. So we download stock price of Walmart and Target and dividend information. And how do you calculate daily return? That's on holding period return. And you use this formula. Where is the formula? Yes, percentage return. Yeah, here is the formula. So daily return on Walmart stock is P1 minus P0 plus D1 divided by P0. So that's the holding period return. So P1 is ending price. So day one price minus P0, day zero price. So that's the capital gain. Plus you need to add the dividend. So D1 divided by P0. So you apply this percentage return concept to the first day return for Walmart stock, and we have 252 trading days in 2019, and then you can calculate average return, and you can calculate the standard deviation of the return. How? So we have a formula here. Yeah. Standard deviation is the square root of variance, and variance based on historical 2019 data. Sum of squares deviation from the mean. So you need to calculate mean first. So use the 252 daily return, calculate the average. And for each day, from day 1 to day 252, deviation from the mean. And you square and add them all, divided by 251. So that's the variance. And square root is the standard deviation. That's how to calculate standard deviation. And it's too many to include 252 trading days return data. That doesn't fit in one slide. So that's why I'm using 4 years annual, 4 data points to explain how to do the calculation. So let's take a look at this annual return example. So suppose you are given this 4-year data. First year return, 15%. Second year return, 9%. Third year return, 6%. Fourth year return, 12% per year. So based on this data, how can you calculate what's the standard deviation of this stock return? Then you apply that knowledge you learned. So you first need to calculate average return, mean, right? So how to calculate mean? Add all of them and divide by 4. There are 4 years. So 10.5% is the average return during this 4-year period. And then what do you need to do next? We need to calculate variance. And how to calculate variance? What's the definition of variance? Sum of the squared deviation from the mean. So divided by 4 minus 1. So we need to calculate the deviation from the mean. So mean is 10.5% and the first year return is 15%. So 4.5% is the deviation from the mean, and we need to square, and we do the same for all and add all. So I strongly recommend you use decimal, not percentage, in this kind of calculation. It's easier to handle decimal. But if you really want to use percentage in the calculation, that's okay. You will get the same answer, but you need to be consistent. So if you start using percentage, you should keep using percentage. Otherwise, in the meantime, you just switch between percentage and decimal, and you are not consistent. It is easy to make an error. So you need to be consistent. So I strongly recommend you use decimal, and at the end, convert it to percentage. So you add all the scared deviation from the mean and divide that sum of scared deviation from the mean by 4 minus 1, so that's variance, and take a square root, that's standard deviation, so in decimal. So in percentage, standard deviation is 3.87% is the standard deviation, and that's the measure of risk. So you can do this, you can apply this logic to Walmart's 2019 daily return data, as well as Target 2019 daily return data, and you can compare which stock return was more volatile. So higher volatility means higher total risk. So and any questions so far? So the problem of this chapter 12, 13, and 14 is when you hear how to do the calculation, it sounds reasonable and doable. But if you just sit down and try, and if I just give you work and then if you try to answer that question, you will have a lot of difficulty before you practice a reasonable amount of questions. So that's why I ask you to plan ahead. And that's why I posted all questions, 12, 13, and 14. These concepts, 12, 13, and 14 concepts are supposed to be quite complicated. But this is an intro class, so I cut down too much details and just focus on the most fundamental core, but still, this is a very math heavy, statistics heavy, and complicated analytical problems. So it's easy to get lost, especially if it has been a while for you. You took math and stats courses a long time ago. If you don't have a strong fundamental in analytical skills, those students in the past have had a lot of difficulty. So I recommend you plan ahead and start those problem sets, connect problem sets early, and fully utilize my office hour if you have any questions. So don't hesitate. So I have today I have an office hour from 1 to 3 p.m. So, and you don't need any appointment. So anyone coming to the office hour, yeah, first come, first service, serve the basis. I'm making it open. And when one student joins and it looks like that student's question can be answered in public, if that's the case, I will admit all other students and answer the questions. But it sounds like students have a question that should be asked privately. I may need ask, not admit other students for like 10-15 minutes. So if you don't make an appointment, you may need to wait up to 15 minutes. So I strongly recommend you make an appointment if you feel that you want to ask questions in a private setting. Yeah. So I see a chat box movement. Okay. The Bloomberg class code is in the announcement section of Blackboard. Thank you, Jackie, for your help. So I posted the Bloomberg class code. Yeah, you're welcome, Catherine. So get the class code and register for BMC as soon as possible. So you still have enough time to complete it, but don't wait until the last day. So definitely that will be too late. And again, let me emphasize again, 10% of your grade is from this important PMC experiential learning and this project. So I will not accept the late assignment. I cannot accept late assignment because of the grade deadline. Instructors are responsible for submitting grade on time. So my hands are tied in this case. I cannot accept the late assignment. So you must plan ahead and complete the assignment. So you should be familiar with how to do the calculation for standard deviation and why we are using standard deviation to measure risk. This is based on the normal distribution. Historically, when we see asset returns, roughly risky assets return for a long-term data, when we observe long-term data, not just 1 year, reasonably long period, many assets returns look similar to normal distribution. And the beauty of normal distribution is the mean and standard deviation. Once we know it, we can answer any questions. So higher standard deviation, so target versus Walmart. So when we do the when we evaluate the historical returns of Walmart and Target, for example, look similar to the normal distribution, and higher standard deviation means this normal distribution bell shape is more wider. That means returns are more spread out. So higher standard deviation means bell shapes is wider. That means more extreme returns have been observed. That means higher risk. More returns have been more volatile. So higher standard deviation means the return distribution has been more volatile. So that's why we use standard deviation as a risk measure. And also, there are several ways to calculate average return. So there are arithmetic average returns and geometric average returns. So we are gonna discuss it on Monday. And we will also discuss the efficient market hypothesis. Very, very important concept, especially for those who are gonna take investment class. This concept will come back. And this efficient market hypothesis is a $1 trillion question. So index fund, S&P 500, the index versus stock picking. So that kind of important question is answered by the efficient market hypothesis. So we are running out of time. So the last day of register for BMC, so your BMC access will expire. The class code will expire at the end of the semester. So the project is due by December 9th, and that time your PMC access code will almost expire. So yeah, that's good. So finish the PMC early. So you are gonna lose PMC access at the end of this semester. So you need to finish as soon as possible and take notes. So this free service will not last forever. So this is a very exceptional situation. So usually they charge. So if you wanna access BMC after this semester, you need to pay $149. So you fully utilize this service when it is available for you for free. So this is the end of today's class. And if you have any question, you can stay or you can come back to my 1 p.m. office hour. Bye, everyone. You're welcome. Bye. Have a good weekend. Thank you, Meng Ting.